Good morning and welcome to the KDI Wealth podcast. Today, I get to be joined by Jack Elder, who is the head of advanced sales at Kestra Insurance Planning. So thank you, Jack, for joining us.
Glad to be here. Thank you.
Maybe you can share a little bit more about yourself and then we can hop right into the questions.
Sure, no problem. By background, I'm a lawyer with a master's in tax, and I started practicing law in the suburban DC area in the early 2000s. We're going to be talking about insurance today and when it's useful for a family. At the time, the estate tax exemption was $1 million. So almost all of our clients were going to be estate taxpayers at the federal level. And then at the time, Maryland, Virginia, and DC also had its own separate estate tax. So we were drafting ILITs for every client pretty much in the early 2000s. And then as the exemption grew, first with the Bush tax cuts, our clients were wealthy, so they were still subject to the estate taxes. I had a complex planning case, like a second marriage, unequal distribution of wealth, family business, where it was just like a lot of moving parts. And the client, their advisor, came along with them to be a part of the process, work in a team environment, which I support 100%. And they had with them someone who basically has my job description today. And that is that they act almost like a consultant and support that advisor when you're dealing with a complex client situation where an insurance product is in the mix. And that's what I do today. And I've been doing that since 2008. So since 2008, I've worked with advisors when their clients have complex or confusing situations that involve an insurance product where you want to avoid pitfalls and take advantage of opportunities. Sometimes there's lots of zeros at the end, but not always. And I'm there to support the advisor and be an extension of that advisor's team and work with the client and the client's other professional advisors to help them solve problems when insurance can help them do that. So that's a mouthful, but that's what I do. And that's how I arrived where I am.
Thanks for that, Jack. And so actually led me right into the next question that I had queued up was, can you just walk us through maybe a recent case, anonymous, of course, but where insurance played a pivotal role in helping a family preserve or transfer wealth efficiently?
Yeah, sure. I'm working on a case right now. It's a high net worth family. The family is worth $60 million. They have very wisely funded three trusts already. We'll call it A, B, and C. It's for three of their kids. They did not fund them evenly, incidentally. And so they've used $20 million of their exemption, $20,600,000 of their exemption. So that was really smart. That 20,600,000 will grow. So the family's in their 70s now. Let's say that compounds for the next 20 years, right? It'll double, right? So they've done something really smart. And the excess that it's 20 now, let's say it doubles to 40, right? Rule 72, but let's say it doubles once. So you've got $20,000 of growth that escapes the estate tax permanently. So if the estate tax, let's just say, is 40%, then that's really smart. They just, by strategically retitling, they've eliminated $8 million of taxes. But that leaves them with another million of an exemption to cover $60 million of net worth. So what I'm going to help them do, and what I'm in the process of helping them do, is continue on the path of making strategic gifts to knock down that estate tax liability. So we're going to make some moves with how the assets are titled and make gifts, taxable gifts, file a gift tax return. No gift tax is due, but you do file an informational return, get that future growth outside the estate, and then whatever we can't get rid of, we'll use life insurance to help cover the cost of the estate taxes, provided the life insurance gives lift to the overall portfolio. So you wouldn't use life insurance unless it increases the net to heirs, and it does in most cases. Does that make sense? So you solve as many problems as you can with a pen and pencil and planning and being smart. And then for the rest, as long as life insurance provides a lift and increases that legacy and that net to heirs, it gets added to the mix.
So when you're talking life insurance, you mentioned at the beginning an ILIT. What other ways would you look to solve for that?
Well, in their case, you have marketable securities. So that gives you some options that you might not consider if it was a family business or real estate, but it also limits some other options, right? So the spectrum of solutions changes depending on the client asset mix. In this case, you would make strategic gifts. So do what they've done so far, but under the OBBBA, the new Trump tax cuts, they've got $10 million more to gift, which they should do. They should pick assets strategically, because those assets don't get a step up in basis, only the ones that they die with do, right? So you're going to be smart about the assets that goes into your trust. And then for the what's left, you have a couple choices. So they could consider using GRAT, which I don't want to get into the details. It can be complex, but think of it as a trade. You set up a trust for yourself and you start to do a trade with that trust. And that trade is, I'm going to give you assets trust in exchange for an annuity payment back. And you cross your T's and dot your I's and follow some IRS rules. And it can lead to some wealth transfer opportunities that can go one generation.
When you look at ages of people that start to consider estate planning and insurance planning, is there a right age, a right time?
Great question. My experience is if the client views themselves as a steward of wealth, you can do it pretty young. But that mentality, that steward of wealth mentality, isn't present with every client. And you might have a client who had their own HVAC company, right? They just sold it. They're 54 years old. The nicest thing they've ever owned is a jet ski. And they're now in a completely different situation. They're a multimillionaire. They've been saying no to themselves their whole lives and saving and reinvesting in the company. They're probably not in the right mindset to think, okay, now how do I efficiently transfer this wealth to my kids who are in high school, right? They're just not thinking that way. So you have to help your clients and educate your clients on their options, on what their future tax situation might look like, and whether or not they're ready for that wealth transfer move. You could take a similar aged client who inherited their wealth or grew up in a different environment, and they're viewing themselves as, I'm the caretaker of this wealth. I'm going to transfer it wisely and with intention, and I'm going to navigate taxes when I do so. That guy that sold his HVAC company is going to get there, but he's probably not there yet. So I'd say it's not an age, it's a mentality. And I would say first generation wealth hits that mentality a little later than second or third generation wealth. And I would say if you said, no, I really want an age, I would say low to mid 60s is when you really start seeing wealth transfer techniques take center stage.
Thank you. Speaking of business owners, they make up a large portion of our client base. What are some of the strategies that you're using to support either succession planning or liquidity events through insurance or estate?
Great question. So I'm going to look at this from a couple different perspectives. One is business succession, say it's going to stay in the family. So you and I are the business owners. My son's going to take over for me, and your son or daughter is going to take over for you. And by the way, I should say daughters because I got two girls. So my daughters are going to take over. So what I'm going to do is I'm going to make sure I'm considering estate taxes if they're in play. If I don't have liquidity in my estate, where are the estate taxes going to come from?
Right.
If I don't have liquidity, they're going to come from one of two places. One, my family, my girls are going to have to borrow against the business to pay the government, right? Maybe the government would finance that debt, allowing them to use the business as collateral. I bet you, as my business partner, probably not a huge fan of that. Plus, who wants to be in hock to the government? Nobody. Or Bank of America or Wells or any like you don't want that, right? The other option would be to sell it, which our plan is not to do that. We want to keep it in the business family. So one thing we want to do is use insurance for estate taxes. So we preserve the business. Let's say my two daughters, this one wants to take over the business, but this one doesn't. And she wants to be a nurse. My wife and I want our wealth transfer to be even and fair. We love our kids the same. We're not trying to benefit one over the other. We could buy a life insurance policy to benefit the child that's not going to be participating in the business. When the second of me and Jenny passes, the business goes to the daughter that's participating in the business, and then cash in the form of a life insurance death benefit goes to the other one to equalize our wealth transfer, but not be the same asset. If you have, and I'm sure you've seen it, and I'm sure your clients have lived through this, many of them. One child's involved in the business, one child's not. It sets up a potentially toxic environment for the family. So you can use life insurance to think of it as like family harmony insurance. You can really solve problems. I'll give you one more example. You and I are in business together. We're probably going to sell to a third party someday, but together we're better than either of us could be alone, right? The sum of our parts are superior to the parts. If I die, it hurts the business. If you die, it hurts the business. And it would hurt our value. We want to make sure that no matter what happens, we think it through, have intention, and be smart and be tax smart about it. In that situation, life insurance plays a critical role because I would buy a policy on your life and you would buy one on mine. And the purpose there is if I kick the bucket, you really like my kids, but you don't necessarily want to be in business with them. So instead, you're going to use those proceeds to buy out my family. You end up as the sole owner, and we have smoothed out a otherwise extremely challenging transition period. And by the way, the type of insurance we use in that case is probably term insurance, so we can watch the budget at the same time. It's not going to break the bank to solve a problem.
That makes total sense. Switching gears a little bit, and this is actually a conversation we had just a couple weeks ago. Many of our
Sure.
clients are near or around the age where they're starting to consider long-term care. Maybe the question a little bit more geared towards long-term care in the context of legacy and lifestyle. How can we use insurance-based solutions to help in this area?
Great question, and near and dear to my heart, because my grandmom, God rest her soul, had a long-term care policy that her husband, my granddad, God rest his soul, purchased for her. They each had a small policy. They were not huge policies, but they weren't super wealthy. My grandfather aged at home and passed away at home. My grandmother had Alzheimer's, so after he passed away, that wasn't possible. In both cases, the long-term care services they got were very expensive and would have wiped them out, especially in her case. Alzheimer's can drag out. She had a long-term care policy and it preserved assets that went to her children. It also helped my mom, who was the primary caregiver, make decisions and find support. So it does a couple things. So I'm going to cover a financial side and a non-financial side. The leverage you get from a long-term care policy, and there's lots of different flavors, but when I think long-term care today, a modern product today is built on a life insurance chassis, but it's designed for long-term care protection. So a policy like that does two things, one financial and one not. On the financial side, the leverage you get on these policies is 7 to 10%. So if I put in $100,000 over a period of time or all at once, I'm going to get maybe $700 to $1 million worth of long-term care protection. So it's just a good use of my money, right? If there's a 70% chance that I'm going to have a long-term care event, if I'm married, 90% chance one of us will, then it's a really, really good use of my money. And if I don't need the long-term care, it's not like auto insurance where I just lose the money because I wasn't lucky enough to get in an accident. Instead, my family gets the money back in the form of a tax-free death benefit, right? It's going to cost me $100,000 a year to be sick or 150, and I want to age at home like my granddad. That's what it's going to cost a lot of our clients. Wouldn't you love to get that leverage rather than burn your assets to get there? And think about this. If I had to tap qualified assets, which a lot of America, their wealth is in qualified assets, I'm paying taxes on top of it. So that 100 becomes 170 just because I got to cut in Uncle Sam first. So terrible, terrible result. On the non-financial side, each of the companies that we represent has coordinated care services and concierge desks to help identify caregivers, support in the area, that non-financial benefit. So I always think, like, when I talk to a client, are your kids in the same zip code? If they say, no, we're in Florida now, or we're in Arizona now, and our kids are still in Illinois, well, who's going to help you? Like, what elder care services do you think are good in your neighborhood? And everyone doesn't know any. Well, guess what? What if we had someone on standby who did know, whose tentacles went everywhere and had all the answers? And that coordinated care in combination with the leverage on the protection side, on the pure smart use of your dollars together, are a critical tool, I think, for almost every family.
Two things on the pieces that you shared there. When we're having discussion with clients, some of the things we always talk through, and specifically with the new, we refer to them as hybrids, life insurance policy with a rider or an enhancement, is that some of those old school traditional insurance types, you pay and you pay and you pay, and by the time you need them, either premiums are increasing and your benefits going down.
Yeah.
With the contractual basis of a hybrid, it makes it much, much more predetermined, as well as you know exactly what your benefit's going to be.
When I said a modern product, I meant a fully guaranteed product where you're not going to get that premium increase. That said, and we don't really market a ton of the traditional LTC where you could get a premium increase. Those products are worth holding on to if you have one. Maybe you don't pay those increases. In the life insurance company's defense, they cannot raise their premiums for profit or operating capital. They can only raise the charges due to their actual claims paying experience. That means if they assumed healthcare costs are going to increase by 3% over the next 30 years and they increase by 6 and no one lapses their policy, you end up just not having enough in the coffers. And so you have to go back to your clients. It's a terrible thing that happened, but I wouldn't say it's sneaky. And it's not like there's executives lining their pockets or going on trips to Cancun with your increases.
It's purely due to the inflationary piece of healthcare in general.
There's a math that moved away from clients and the insurance companies.
Yeah. The other piece I was going to add to your answer was that, especially with married couples, I didn't know the 91% statistic
Yeah.
that you shared. But typically, when we're talking through that, it's that whole piece that, hey, if all of a sudden first of the two spouses needs LTC, it very well could change the financial situation for the second spouse.
100% will. Yeah. Yeah. And a great way to start that conversation or think about it is because this is how long-term care events start. Dad went to the hospital and he's not coming home. First, he has to go to the rehabilitation center. Then he'll be brought home. And we live in a house that has stairs and he'll be in a wheelchair or in a walker. Can you lift your spouse?
Right.
Can your kids? Like we haven't even gotten to the finances yet, but agree 100%.
Yeah. Coming full circle, how you and your team operate.
Sure.
When you guys collaborate with advisors to integrate these insurance strategies, how do you do so without disrupting either the investment plan or overall financial strategy?
Great question. What we do is not at odds with the plan. We complement the plan. So our perspective and goal is to collaborate and complement, right? Not to replace. And from how we work with advisors, we do that in a bunch of different ways. However, the advisor wants us to support them, we will, right? Whether it's just, hey, tell us what the best 5 products are and we go from there. Or if it's talk to our clients, you're the experts, this is what you do all day. We'll support you any way you want us to be supported. Dollars are finite for most of us. And so you have to be smart and keep your eye on the budget and weigh your priorities. And insurance is not the answer to every problem. It is designed to take risk off a balance sheet. Some clients are not in a financial position to be able to remove the risk, and it's a sad state of affairs. But when it makes sense and it provides an enhancement, that's where we shine and provide value. Remember when you were in 9th grade or 10th grade, whenever you took algebra, and maybe you could look and you could figure out what the answer is, you naturally knew, but then the teacher said, you have to show the math. I think when it comes to financial planning and providing solutions to clients, whenever you're using an insurance product, you have to show the math. Does it provide enhancement? Show it with and without, and then let the client decide. And don't let a bias against products deter you from giving good advice or taking good advice. If it provides an enhancement, if it pencils out, it pencils out.
One last question for you, Jack, and we'll
Sure.
wrap it up here. If there's one thing you could leave us and our listeners about the role advanced insurance planning can play in a modern wealth management strategy, what would that be?
That when you are considering what is best for you and your family, or if you're an advisor, when you're considering what's best for your clients, view insurance products, life, LTC, annuities, which are, think of that as like insuring your income, like disability insurance. Picture these products as tools in the toolbox. I like to say, what's better, a saw or a hammer? And there's a natural follow-up question, which is, well, for what?
For
Like,
what?
are you trying
Yeah.
to saw something or
Right,
hang something on
right.
the wall, right? Because a saw's not so good at hanging something on the wall, but making a clean cut, a hammer's not very good at that, right? So this is just one of the many tools that fit in the toolbox. And there's plenty of other tools that do different things. But these products, when used correctly, can provide benefits that the other tools in the toolbox just aren't designed to do. So have an open mind to all the tools in the toolbox just to see what makes sense for you. And then check the math. And if the math provides an enhancement, great. And if it doesn't, you can rest easy knowing that you were thorough and that you did right by the client by considering all the alternatives.
Thanks for that, Jack, and thanks for your time today. Been an absolute pleasure. And
Bet, buddy.
yeah, we'll see you out here, in a couple weeks now for the Wealth and Wellness event?
That's right. I'm looking forward to it. Thank you so much for inviting me.
Thank you. You have a good day.